Welcome to Views from the North, a Canadian Rates and Macro podcast. This week I'm joined by Robert Kavcic, a Senior Economist at BMO Economics. This week's episode is titled, Has Housing Bottomed? I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Rob, it is time for the annual update on housing that you provide for us. It is always among the most listened to episodes, so thanks for coming on again.
Thank you for having me back, Ben.
We're not only going to do housing, we'll also touch on the Bank of Canada, but because it, I think, will be a non-event, and I think that's probably a kind way to put it. I could just say it'll be totally boring, but we'll see. I thought housing would be a little more interesting for this week, so let's start with housing. I'm just writing the home sales preview for June and trying to figure out exactly where things are, and it looks as though there are signs of, I don't know, not life is maybe the wrong word, signs that things may be bottoming in some of the hardest hit markets. And I guess, where do you see things? And I guess, importantly, let's start with Ontario and BC, because those have been by far the weakest markets.
So the question, has the market bottomed? I would say yes, but, and the two big buts would be, number one, it's not everywhere. Okay, so it's not every segment of the market. And then number two, we're not going to see a big rebound or a big recovery. So it could be going sideways for still some time. And we're not talking months, we're talking quarters or years. So BC and Ontario, I think a couple things. Number one is that was obviously ground zero of the correction, right? So the area that we are not seeing any signs of bottom, and we probably won't for some time still, would be in the condo space, right? Especially the smaller bachelor, one-bedroom, investor-dominated condo space where there's no incentive for investors to come back in the market right now.
Let's call those the shoeboxes in the sky.
The shoeboxes in the sky are dead money, okay, as we've written before, dead money. So investors are not coming into that asset class, and you have a huge pipeline of supply still coming to completion.
How many years until those are done? I've never looked. I've never even asked. I assume that when those at least stop coming online, then the market can maybe clear, and then we can start to move on from here. But how many more years? Because it takes years to build these buildings now. So
sure,
how many more years?
You could be 3-4 years, like through construction, right? So peak was 21, 22. You're pushing probably into like 2028 to clean it out. And like from a month supply perspective, like to absorb this stuff, when you divide by zero, which is where demand is right now, the month supply basically go to infinity. So it's not the most reflective measure, obviously, but...
Well, it doesn't help that population growth is pretty much zero. When these were all being built, it was on the assumption that we'd have infinity population growth in perpetuity.
Right, and you had investors buying like half of the stock. So what does an investor do right now? Like, you're not going to come into the market with, like a 4.5% cap rate when rents are falling, unless you have some kind of extreme price expectation. But obviously you don't have that anymore because prices are going down, they're not going up. So when the investor is not there, there's zero pre-sale activity, and eventually the supply pipeline will stop because nobody's going to be breaking ground on these condos in, let's say, 2027, 2028. And eventually the market will clear out.
Eventually. So a couple more years of softness on that front. But the bottoming, moving on from the bottoming itself is happening in which markets then?
So geographically, there are markets that never really got into a problem to begin with. Okay, so we can ignore those. We can ignore most of the prairies. Calgary's weakened a little bit, fine, but it came off pretty hot levels. We could ignore like Montreal, Quebec. Those markets never weakened. They were never frothy. Atlantic Canada, same thing. Atlantic Canada arguably is frothy, but they never kind of went through the correction Toronto and BC did. So it's a BC-Toronto story, and then within these two markets, and especially Toronto, you do probably already start to see some evidence that single attached is bottoming. And this is what we've argued from day one. So when we called this correction back at the start of 2022, right? And we got it pretty damn accurate. And we kind of, as we were watching this evolve, we said the first thing we're going to see as a sign of a bottom is, okay, look where the scarcity is. And the scarcity is, unlike the condo space, which has a huge pipeline of supply, the scarcity is like those 3-4 bedroom single attached houses with backyards in the core of the GTA or Vancouver that we haven't built for 20 years.
And can't build any more of.
And we don't build any more of either. So that's where the scarcity is. And that's probably the first area you're going to see the market tighten up and start to come back. And you can maybe for the first time in the last month or two see it a little bit in the numbers. Anecdotally, if you go around, you can kind of see some of those properties clearing pretty quickly now at price levels that are pretty close to making sense again. It's early, but I think for the first time we're seeing something there.
Things are moving. I mean, in my neighborhood-ish things, I've seen some things move that have not moved for a long time. That being said, there are still plenty of other houses that are still for sale and have not moved for a couple of years, and they just, I think I've noticed prices have started to adjust lower. Like people have accepted that I'm not going to get the, I don't know, pick a number, 1.5, 2.5, 3.5 million. I'm going to cut it by 500,000 or something, like real big price decreases, because the prices that people were expecting and paying in 2021, 2022 were not sustainable at all. I guess like you're saying then that prices on the detached front are now reasonable from an affordability perspective?
You know, we're pretty close. Like we're not back to where we were pre-pandemic, let's say, but there's a scarcity aspect to single attached too, where you're probably not going to get affordability back to where it was 10, 20 years ago anyway. Yeah. So like the benchmark you got to hit's probably a little bit higher, and we're getting pretty close to that, I would say.
So if I want a bigger house, I should look at it now.
Well, yeah. And so the other side of this is too, there's not affordability or valuations haven't actually got to levels where you could call them cheap, right? And would bring a flood of buyers or investors back into the market. But hence why we don't think prices are going to really spring back. But it does argue for single attached to at least be flat and bottoming out from here.
Okay.
Even if other sides of the market are still correcting.
I mean, that's effectively last year when you came on. It was just over a year ago. The title of that episode was Canadian Housing, the End of an Era. And that was exactly right. Like, don't expect the home price increases that we got for, I don't know, decades, effectively. And if prices, I guess, go nowhere for a while, that your affordability actually is improving because wages pick up and incomes go up, and that provides some improvement on the affordability side. So that part's important. That covers, I guess, Toronto and Vancouver. You said the rest of the country is in better shape. Maybe go in a bit more detail there. Like, I think you could probably argue for a lot of those places that that's probably where the construction needs to be. So you probably don't need any more units in Toronto or the surrounding area for that matter, or Vancouver and the surrounding area there. But in parts of Quebec, in parts of probably more of the city centers elsewhere, you could definitely use more supply. And the run up in prices has really stretched affordability in a lot of those places. And so I'm not sure what the solution is there, because unless you get, I'm not even sure what, I guess, a big interest in interest rates to really get people to pull back, like what's gonna improve affordability, or at least halt things from getting worse. Like it should that, I guess, be the focus for policymakers? Because I know they're still focused on like build, which we've said is not the best idea. Let's put it that way. But maybe in those places, it's a better idea.
Yeah, and then like the market's kind of working, because in those places, housing starts haven't come off nearly as much as they have in BC and Ontario, right? So the market's kind of working in that sense. Like Alberta is unique. Okay, Alberta is almost on an island by itself because that population is still growing like 2 or 3%. Still have like 40,000 people moving in there from everywhere else in Canada. So the market's cooled down, but it's still a really, really strong market. And then look, you throw higher oil prices on that economy too, and it's head and shoulders stronger than the rest of Canada, just from a growth perspective too. So that one's a bit of a weird one, because coming into the pandemic cycle, Calgary, Edmonton, remember those markets actually just went through like a 6-year bear market, right? So valuations there were actually very, very favorable. So they were not really exposed to the same kind of corrections, because valuations to begin with were much more favorable. And look, Toronto cooled off. A lot of investment capital flowed to Calgary. That market took off for a couple of years. That's settling down fine, but it's probably going to find stability. Atlantic Canada is funny too because it's such a small like demographic base to begin with. And when you add big population growth to that region,
Doesn't take much.
the infrastructure gets stressed immediately and significantly, right? So construction activity hasn't pulled back there really, even though population growth has cooled off a little bit because they've been so underbuilt for the last couple of years that they're still catching up. And anecdotally, what you hear when I was out there traveling in a couple of months ago, speaking to builders and stuff like that, and what they told me is like, look, we're not seeing the same kind of impact here on the construction side. And what we actually are seeing is we're still struggling to get labor. And now we're seeing a lot of guys from Toronto, whether it's like electricians, plumbers, or whatever, projects coming to completion with no new work in the pipeline. What are they doing? Well, they're coming out here and they're finding work. Like they're still finding lots of it. Right?
That's okay.
Yeah.
Labor mobility is a good thing.
That is labor market mobility working. Yeah, exactly.
All right. That's positive. What about demographics? You mentioned that word a few times. Important part of the housing market. You're writing a piece this week with our chief economist, Doug Porter, on demographics. Right now, we have zero population growth, or Stats Canada would lead you to believe it's negative. I'd probably say it's probably closer to zero, maybe small positive, once revisions are all in, that is. How do you guys see that evolving? And how do you see the impact on housing as the demographic profile of Canada changes, one, and as the I guess the immigration profile changes as well?
So we're kind of talking about two things. So big picture demographic profile in Canada would be one where the population is obviously aging, the birth rate's falling. The millennial at the peak is like 35 right now. The next 10 or 15 years, housing demand within Canada is probably going to be pretty soft because that whole cohort has already gone through and added to housing demand incrementally, right?
Okay.
Saw the same thing through the 1990s. It was their parents. It was the boomers then. So that's the big picture. And it kind of argues, again, for the housing market to be pretty soft going forward for the next decade because that demographic support is kind of faded out or it's aged out, right?
So now I have time to buy this other house that I may want.
Yes,
Okay.
you have
All right.
time.
It's
Yes.
looking good.
You're not competing anymore. The other aspect is with respect to like the big swing in population growth that we're seeing right now, which is kind of a short-term disruption on top of that bigger trend, which obviously relates to non-permanent resident flows and the caps that Ottawa put in place. So from that perspective, we're probably going to be at zero plus or minus for this year, for 2027. And by 2028, 29 and beyond, we go back to just under 1%.
Yep.
As the run rate for population growth. And that's a level that kind of makes the system work. We can supply that on the housing side. We need that for labor force growth going forward. That's kind of about the sweet spot. But for now, though, like what happens when you have a massive amount of investor-owned condo supply coming through the pipeline, coming into completion, getting flipped onto the rental market? You have record purpose-built rental supply under construction because of a lot of incentives, CMHC incentives, MLI Select, all that stuff. Doesn't really reflect market conditions on the ground today. All that stuff's come to completion at a time when population growth has fallen to zero. What's happening to rents? Down, 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 down.
Yep.
So that's something that we're probably going to still be fighting with, or the market's still going to be fighting with for a couple of years still.
Okay.
And again, what does an investor think about this? Well, this is not good, and the investor just does not come to the market.
I mean, it probably suits me. We'll see where my kids end up at university, but I'm like 2.5 years away, I guess. So that won't be the worst timing if I need to buy him a condo or rent him a condo or something. I guess we'll see on that front where he ends up. Okay, so when population growth picks back up in 2028, how should we expect pricing dynamics to change at that point? Because, I mean, 1% isn't small from a population growth perspective. It should be meaningful, especially the delta from zero will be a lot. And that should tighten up the market, I would think, at least especially on the single family front. I guess, like, should there be more normal-ish price gains, something along the lines? Like, price gains should probably be over a very long period of time in line with income growth, since that's what drives affordability. So you're looking at, I don't know, anywhere from 3 to 6%, depending on the year, 3 in a bad year, 6 in a good year. Is that fair to assume after 2028 that that's kind of the run rate somewhere in there?
It's probably fair to assume. So a couple of things, assuming you have like neutral interest rates, more or less holding around neutral. Right?
We'll talk about interest rates next. One thing at a time.
We're pretty close to neutral now. So let's say we have stable interest rates. You return to 1% population growth. You clear out the excess inventory. Yeah, you're set up for a neutral environment where, like historically, you look in Canada, you look across even like the whole OECD. If there's a pretty clear relationship between like real house price growth and population growth, right? So if you're settling into about 1%. That argues for, let's call it modest real house price growth.
Okay.
About in line with the rate of income growth would make sense. I would say maybe 6 is probably too high. That was a period that we saw like the last 10 or 15 years when you had a lot of building demographic pressure. Let's say you have 2% inflation, you're probably like, 3-4% house price growth.
Okay.
Roughly in line with income growth. Probably not a whole lot more though.
All right. Well, hopefully we get, I hope for better income growth. I'm just too optimistic. That's all. Okay. That's cool. Thank you for that outlook on the housing front. There's the one thing we did not cover was interest rates. Right now, the bank's on hold seemingly at least through the rest of this year. Next year's a bit more of a crapshoot. Depends on where trade ends up, where oil ends up, where a whole bunch of things end up. But for now, it's pretty clear they're going to be on hold for a while. Next week's meeting is, again, it should be a non-event. Snoozer would be my guess. There's not a whole lot they can say that's different from last time. They didn't give us a whole bunch last time either. And oil prices are down from the last meeting. Great. But the war just started back up overnight. So who knows where oil prices will be a week from now, a month from now. And that uncertainty is what will keep the Bank of Canada relatively cautious in their wording. I think they'll keep the concern on inflation somewhat on the high side, like they don't want a repeat of 21, 22, and the real acceleration of inflation they got then. So they'll talk about watching for broadening of inflation pressures and that. And I don't think the monetary policy report is going to have much in it either. Q2 GDP will probably get a decent little upgrade. Q3 probably gets introduced at somewhere either side of 1%. I guess somewhere just kind of modest growth, consistent with what we've seen over the past 18 months. And inflation, I mean, honestly, they're really literally rolling the dice on where oil prices are going. So who knows on that? And the output gap probably stays pretty steady since Q2 looks a little better. That'll offset a lot of the weakness in Q1 and Q4. And so rates going nowhere, I guess. And we've seen Government of Canada bond yields trade in a pretty, not tight range per se, but they've been pretty range bound over the past really this year to date, and you can even go a little bit further back, but they've been mostly range bound except for a few short episodes. I guess with that rate outlook of the Bank of Canada on hold, which means variable mortgage rates on hold or steady where they are, and term mortgage rates probably just bobbing around levels where they've been. So like the 5-year rate, maybe the low end of that's like high 3%, 380, 390, maybe if you're lucky you get 375. To just above 4%, and we just bob around in that neighborhood. What impact does that have on housing, if any? And if it just means that we stay here, that's fine. And then at what level does housing really do a lot better? And then at what level do things really get stressed? And then we're in trouble on the high side. There was a lot of questions there, sorry.
No, that's cool with the bank. So the bank firmly on holds. Let's say you have variable like 365, 375. You have 3-year fixed. Like around 4 and 5-year touch higher. Nobody takes 5-year fixed now anyway, because
not if 3 years lower.
Not if 3 years lower, and variable is that much cheaper. So that's where the market is, and like this just completely reinforces what we've already talked about, that housing might find a bottom here, but it's just going to kind of go sideways because there's not going to be any juice from interest rates. And you and I both see the bank very firmly on hold. To get some traction in the market, look, when we do like the affordability arithmetic, we look at, let's say, like what it costs the typical homeowner to carry a mortgage on an average price house relative to income. Right now, we're still a little bit on the high side where it's tough for a lot of people to get in. If you took that, let's say 375 as the lowest mortgage rate in Canada, and you took that down to like 275 or 3, that arithmetic starts to get really compelling. And unless you're in some kind of recession or job loss situation,
I don't know how we get there.
I don't know how we get there, first of all. So that's why we don't think it's going to happen. But if you did, that market would tighten up quick. I think it would come back quick.
Okay.
So I would like watch those levels.
I guess if the trade, if USMCA blew up and the US actually pulled out, as opposed to where we are now. That is one possible world, and that's what the Bank of Canada's pretty much said, that they would look at cutting. Whether they'd be cutting aggressively or not is a separate question, but you can believe the market would rally a ton on that. Mortgage rates would fall, and whether they'd fall 100 basis points, that might be a little more challenging, but one scenario, I guess. So what about the other way?
For the other way, there's not a whole lot of room to move the other way because valuations, affordability is still trying to get back to normal. So let's say the war blows up again and we go back to $100 oil and the Bank of Canada actually raises rates. Oof. Let's say we were a couple weeks ago, like 50 beeps priced in for the year. And when you start taking mortgage rates back up 4.25%, 4.5%, it's just going to forestall any kind of bottoming out in the size of the market that we think are going to bottom out. And it's just going to keep a complete lid on the condo sector that's not coming back to life. So I don't know if I'm explaining this right. I just don't know if there's a whole lot of room for mortgage rates to move up.
I mean, that suggests, just based on housing, which is not the be-all and end-all by any means, but the bank can't really be moving anytime soon. Like if as soon as they push rates higher, and maybe that happens next year, maybe it happens the year after, I'm not sure. But as soon as they do, housing is at best kind of less of a positive, I guess, if things have actually bottomed and improved a bit. At worst, becomes a drag again, and then they've raised rates, and you get an immediate drag on an economy that, hopefully is doing well in all other aspects, because housing is not going to be the thing that drives growth at all. I guess expecting housing to be a growth driver is not something we should be banking on anytime soon.
Yeah, I could see this too. Let's say for whatever reason we're in an environment, let's say we get like a trade deal, business investment, fiscal policy continue to support growth.
Yep.
We're seeing like some good signs even in the last boss that business investment is
maybe turning up.
It's for sure some decent momentum there. Whether it's gonna be persistent, it's gonna last, who knows? But there are signs of it. And let's say you have the Bank of Canada just incrementally pushing rates back up towards where they think is neutral, like middle of the neutral range. And there's solid job growth. If that's the environment where rates are nudging up, then the market's probably still flat. It's probably not going to take the housing market down again because there's cyclical strength there, right?
Yep. Better income growth, better job growth. That's certainly.
But you're still fighting a valuation battle where
that's my problem.
Where it's not going to give you much room for prices to rise.
Yeah. Okay. That's fair.
If mortgage rates are rising at the same time,
we just go sideways more than anything else. But stable market, which isn't the worst thing. So multi-year period of probably flat pricing is the base case, I guess, for now.
I think that's the base case for prices. We'll see more volumes. Just sellers have kind of capitulated a little bit. Asking prices have come down. They'll get more volumes. Yep. So from like a contribution to growth perspective, maybe we're underplaying it a little bit for 26, 27.
That's a good point.
But actual prices, there's not a lot of room. No.
That's a good point. Okay. So the knock on to consumers won't be there, but volumes pick up. That does help GDP on the margin. It has been super negative for quite some time. So some reversal there makes some sense. Okay, cool. Anything I missed? Any questions I didn't ask?
I don't think so.
I asked all the right questions. Good for me. All right, well, thanks for coming on. Very much appreciate it. And I'm sure we'll have you again because housing's the forever topic in Canada and people love talking about it.
Indeed, anytime.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.